Many people think bonds are super safe investments, like a guaranteed return, But that's not always true. Just like any other investment, bonds come with risks. Imagine lending money to a friend. You feel safer if it's a responsible friend, right? Bond ratings tell you how safe it is to lend money to a company or government. Think of it like this. You wouldn't lend a large sum to someone with a bad credit history, would you? Similarly, bond ratings help you understand the borrower's financial health. This helps you make informed decisions about where to put your money. So before you jump into the world of bonds, it's super important to understand these ratings. It's about protecting your hard-earned money. What exactly are bond ratings? They are like credit scores, but for companies and governments. These ratings tell investors how likely the borrower is to repay their debt. Just like a good credit score helps you get a loan, a good bond rating means lower risk for investors. Think of agencies like Standard & Poor's, Moody's, and Fitch as the credit bureaus of the bond market. They analyze a borrower's financial health and assign ratings to their bonds. These ratings are expressed through a combination of letters like AAA or BBB, with AAA being the highest rating. A higher rating means the borrower is in great shape financially and very likely to repay the debt. Lower ratings indicate higher risk, meaning the borrower might struggle to pay back. Each rating agency has its own scale, but they all follow a similar pattern. Let's simplify it for you. Think of it like grading in school. AAA is like getting an A+, the best of the best. These bonds are considered very safe. Then you have AAA, BBB, and so on. As you move down the scale, the risk increases. Anything below BBB is considered speculative or junk grade. These bonds are riskier, but can offer higher potential returns. It's like aiming for a higher grade. You might need to put in extra effort and be prepared for a possibility of not getting the desired outcome. Remember, higher risk, higher potential reward, but also a higher chance of things not going as planned. Section 4: Investment Grade versus High Yield. Understanding the difference. Investment grade bonds, as the name suggests, are considered relatively safe. They are like the star students of the bond market. These bonds typically come from financially stable companies or governments. High-yield bonds, also known as junk bonds, are the rebellious ones. They have a higher risk of default, but can offer juicier returns. It's like betting on an underdog. It's riskier, but the payoff can be bigger if they succeed. Understanding the difference between these two categories is crucial. It helps you align your investment choices with your risk tolerance. Section 5: The impact of ratings, interest, prices, and eligibility. Bond ratings directly impact how much interest a borrower has to pay. Think of it like this. If you have a good credit score, you get lower interest rates on loans, right? The same principle applies here. A company with a AAA rating can borrow money at lower interest rates compared to one with a lower rating. Bond prices also dance to the tune of ratings. When ratings go up, bond prices usually follow suit. Conversely, if a bond's rating drops, its price tends to fall. Lastly, bond ratings can affect who can invest in them. Some institutional investors, like pension funds, have restrictions on how much risk they can take. They might only be allowed to invest in investment-grade bonds. So, there you have it. Bond ratings are more than just letters. They are crucial indicators of risk and potential returns, guiding investors towards smarter decisions.